Yeah, I discovered this thing from a16z, so Andreessen Horowitz, VC company. They have like something that's called states of markets, snapshots from the public and private markets on AI, company building, and more. I'm wondering, unicorns are real. Unicorn year-over-year revenue growth. Top decile revenue growth is nearly 6x year-over-year. So I guess that's the companies, right? What are the deciles? It's a power law business, always has been. In 2025, revenue growth exploded upwards for the top quartile and top decile companies. Far more than for everybody else. Unicorn rule of 40. Yeah, so basically they're saying that in the AI business of today, it's starting to become the winner catch-all, basically. It's starting to become a winner catch-all situation. Interesting. And they run in herds. As private unicorns broke through the 5 trillion market aggregate, it's clear who's driving the trend, the biggest names. The top 10 private companies are an increasingly large share of total unicorn valuation. I mean, yeah. Top 10 companies: SpaceX, OpenAI, xAI, Anthropic, Databricks, Stripe, Revolut, Scale, Waymo, Checkout.com. Top 10, rest of universe. Interesting. I mean, this is just a sign that, yeah, the AI market is consolidating, basically. We are entering the era where now AI startups are going to fail and go bankrupt, and the ones that succeed are going to, take their share, basically. And to be fair, even I see that at my own level, right? Like when I'm trying those coding models, right? Like I only have so much time and energy to put into like 2, 3, 4, max 5 different solutions, right? Like right now I have OpenAI models, Anthropic, Mistral. I sometimes use Perplexity, and I tried AMP once, but like I'm not going to try anything else because that's too much energy, trying stuff. And that's actually like I saw a little video about Siebel and Caldwell. Yeah, in this video here, non obvious insight building a big company, they basically saying one thing that I didn't, is that basically they give the advice to, so it's not for beginners and pre-product market fit people. It's the advice they're giving there, it's for products, companies that have found their products and their customers, and they're basically telling their founders like, yeah, so if you are the 6th or 7th player in a given market, even though you might be making $50 million per year of revenue, it's actually not good to be the 6th or 7th actor in a market, because you're probably just going to trend towards dying over the long term because usually people don't care about the 6th or 7th player in a given market, like in a given marketplace or whatever. They only care about the 3 main, right? Like there's the leader, then there's the alternative to the leader, and maybe a third guy that comes and can mess with the first 2. But like basically, if you're not among the top 3, you have a big problem usually, and you will trend towards dying. And interesting insight, I think, and that seems to be what they mean here, right? Like that's what this graph looks like, right? It's like, yeah, we are going to a state where we are entering an era of the AI market where the big players are going to consolidate their place, and all the smaller ones, like KiloCode and whatever, I forgot their names because of course there's so many of those, KiloCode and Klein and whatever, like they're going to die basically, because they're too small. There's not enough mental space for them to be there with the other big boys. So fortunately they're probably going to be either bought by other big companies or just die alone. What he says about the market: the market is funding a gigantic fixed cost build out upfront, data centers plus GPUs. That's why we have all these shortages in RAM and stuff like that, and GPUs. The debate isn't, is AI real? It's AI, can AI monetization scale fast enough to justify the $4.8 trillion of capital by 2030? The slide implies a binary-ish outcome. If AI becomes a huge revenue layer, approaching $1 trillion per year, hyperscaler returns look defensible. If revenue lags, though, you can get pressure on hyperscaler margins / free cash flow, AI hardware demand, and valuations that assume the capex will earn attractive returns. Not enough to conclude less bubbly from these slides. They argue the pricing logic is tied to profits and required returns, but the risk can still be large, just different in shape from the dot-com bubble. In the dot-com bubble, many public companies had little to no revenue, no clear unit economics. Valuations were often pure narrative. When funding liquidity changed, there was nothing to anchor prices. The crash was amplified by fragile business models and equity issuance at inflated prices. AI boom, today's mechanics. The biggest AI bets are being made by already profitable incumbents, hyperscalers plus mega cap platforms. A lot of the spend is capex, so data centers and GPUs, and that creates real assets but also fixed cost burden. Valuations for leaders are being justified by high expected return on equity, and the payback debate is about whether revenues show up fast enough. That generally makes it less like dot-com's no fundamentals environment, but not automatically safe. Yes, of course. Bottom line, AI is more fundamental backed than dot-com was, especially because the leaders are profitable incumbent. This does not imply a mild crash if expectations break. It implies the bust would look like capex cycle plus multiple compression. Not everything was fake. Yeah, okay. So it means that even if the AI bubble pops, it will not be a crash, right? It will be a correction. It